Okay, hi, good afternoon, everyone. Apologies for the slight delay. Thank you for joining our lunchtime webinar today titled Finding Trading Opportunities in Volatile Markets. So this event is part of a series of events lined up this week for the Singapore Trading Festival. I'm Zane Aw, Research Analyst at Phillip Securities Research, and I'm pleased to be joined together with Ms. Jamie Chung, Head of Warrants Singapore, Macquarie Commodities and Global Markets, as well as Mr. Alvin Li, Director, Equity Derivatives Sales Asia at UBS today, to learn more about how we can deploy some of these trading instruments like warrants and daily leverage certificates, known as DLCs for short, to capture some of these moves in today's volatile markets. So for the flow of today's webinar, I'll be sharing a bit more about the technical analysis for some indices and individual stocks to identify some of the potential entry and exit levels that we can take note of. And thereafter, Jamie and Alvin will be sharing more about warrants and DLCs and how we can make use of them to capture some of these moves. And we'll happy to take questions afterwards. So without further ado, let me just begin with the session. So just a short disclaimer that the information provided is just for educational purposes and you should seek advice from a financial advisor regarding the suitability of the investment products based on your investment objectives. Okay, so first, we're talking about S&P 500. So for S&P 500, we have been trading in quite a range over here. So we have been mainly trading in this descending broadening wedge pattern right over here, and we are currently in this flag pattern right over here. So we can see the price action is actually coiling up towards the near the resistance area of this descending broadening wedge, and this was after we had a bounce over here in this past 1 to 2 weeks after we retested this key downtrend resistance line right over here. So over here, I would say that I would think that the resistance zone is pretty around near the 4,000 mark over here, which is the wedge resistance. And the upper bound of this resistance likely is to be at the 4,100 mark, which is coincide with this uptrend support line, which was being broken down previously. So we could potentially, there could be a potential short opportunity over here near the 4,000 mark, which is the current resistance level, and the exit level could be near the 3,830 level, which is a retest of the recent swing lows, as well as a retest of the key downtrend resistance line. And the lower bound support could stretch to about near 3,760 level, which is the 61.8% Fibonacci retracement level as well. That coincides with a swing low generated at end of last year. So moving on to the Hang Seng Index, it's currently in a downtrend channel over here as well. So this was after we actually broke down of a bearish rising wedge pattern over here in this stretch. So currently we are down about 15% from the recent highs at 22,700. So I would think that the resistance level is over here near the 20,100 level, which is the downtrend channel resistance, and it may stretch to about 20,700 level, which was a previous swing low support over here that was being broken. And upon the retest over here, confirming with the channel resistance, we can observe that it actually turned into resistance over here. So over here near the 20,000 level, we could potentially have a short position if we think that the bearish momentum will actually continue towards, and we can potentially look for an exit in the support zone of about 18,300 to 19,000, which is the current support zone. So I would think that a potential exit level would be near 18,650, which is the 50% Fibonacci retracement level over here. And that might actually be confirmed for a retest of this support zone back over here again. So moving on to some of the other individual counters. First of all, I'll start with some Hong Kong counters, which is Alibaba Group Holdings. So for Alibaba, we are trading similarly to the Hang Seng Index. We are currently in a downtrend channel over here. So this was after we actually broke down of an ascending broadening wedge pattern over here, which was a bearish pattern. So over here, however, we had a breakout that took place over here just recently, last week. But I would think that the range that we might be trading is actually quite small over here for now. So I was thinking that the current resistance zone would likely be the immediate resistance level could be at the $87 mark, which was a previous swing low support back over here in early March. So it was a horizontal level that we actually broke down off over here. Then upon the retest, we might be able to find some resistance over here. The upper range of the resistance could stretch to about $93, which was a previous swing high back in December of last year. Over here, we observed prior to the breakout that took place. And over here, it turned into a horizontal resistance level over here as well. So for the support level, it's currently at $78, I would think, which is the recent swing low levels, stretching to about $83, which is this short-term horizontal level that we broke out of. So for Alibaba, if we were to take the view that it is a bullish breakout from this downtrend channel, we could potentially enter an entry near the $80 mark, which coincides with a potential retest of this downtrend channel resistance, as well as filling a price gap in the process. So moving on to Tencent Holdings, another Hong Kong counter. Similar to Alibaba, it has broken out of a downtrend channel recently after trading in a bearish movement for quite some time, following a break from this uptrend support line. So for now, I think that we are in this resistance zone for now. So this is near the $375 to $397 area over here, where the $375 was a previous horizontal support level that was being reached. And upon the retest, we found resistance, and we actually tried to enter back into the resistance zone on Friday, but however, we saw some resistance was acting over here. So currently, the support will likely be at 375 to 330 to 353 in my opinion, which is true, right? 330 is the recent swing lows, and it also coincides with a 30.2% Fibonacci retracement level, when 353 is a recent horizontal resistance levels that we broke out of. So if we were to take the view that Tencent Holdings could be poised for a continuation of the bullish momentum following this breakout, we could be looking for a potential entry near maybe 347, which would be represent a retest of this downtrend channel that we actually broke out of over here. Okay, now moving on to some of the Singapore counters. So I'll be looking at the DBS Group holdings. So recently we had some bearish momentum coming in, trading in the downtrend channel, following a break from an uptrend channel, the main uptrend channel that took place over here over the most parts of last year. So over here, recently it has broken out of this downtrend channel over here with a consolidation of candlesticks taking place. So for now, I think that we might be entering into the low bound of this resistance zone that's near $33.40 to about and the upper range would be probably about $34.30 over here. And the support zone would probably be at $31.70, which is the recent swing lows that was formed over here before we had a rebound. And this actually coincides with a 61.8% retracement level as well. The upper bound of the support would probably lie at $32.60, which is a retest of this downtrend channel over here, as well as it was a previous key horizontal level over here where price actually traded at. So for DBS, similarly, if we take a bullish view that this is a bullish breakout from the recent bearish downtrend, we could potentially look for an entry maybe near $32.30 upon a possible retest of the downtrend channel. Okay, last but not least, I'll be covering Singapore Airlines. So for Singapore Airlines, we are trading in a descending broadening wedge pattern over here in the chart. So this is a bearish pattern, and we can see volatility actually expanding in this technical pattern. So for now, the resistance level could be at $5.67, stretching to about $5.76. And the support zone could lie at about $5.44 to $5.53. So the support zone, this green color box over here, is actually confirmed for a previous horizontal resistance level of this ascending triangle breakout that took place over here. So, and this was actually, we saw a retest that took place over here last time previously, and before that was before we saw a continuation of the bullish momentum upwards. So over here we might be able to see some support coming near the $5.48, $5.48 price level, which is near the 50% retracement level at $5.46. So if you were to take a bearish view on SIA, we might be able to initiate a potential short entry over here near the $5.75 mark, which is the resistance of this broadening wedge over here. And we might be able to look at for a potential exit level near $5.48 over here when price actually retraces to a strong level of support over here. Okay, so that's all from me for the technical analysis part. I think now I'll pass on my time to Jamie to share more about warrants and how we can use them to capture some of these trading moves.
Thanks, Zane. Thanks, Phillip, for having us, to speak to these 58 participants here. Given that this is, lunchtime and we're tapping into your precious lunch hour, I hope that today's session will be very useful to you. And will give you, trading ideas on how to be profitable in this highly volatile market. Hi, everyone. My name is Jamie, and I'm heading up the Singapore Warrants team in Macquarie. And I'm pleased today to show you how you can use warrants for short-term trading. Just let me share my screen now. Okay, I hope you can see my screen well. And I'll just kick off by quickly telling you why you are spending time to find out about warrants and why you should be even, using them and why you should even consider them, right? Because there's so many products out there in the market. And indeed, there are many products out there in the market, but I would say warrants are a bit of a unique instrument for the reason, that there are really 4 unique points in them. First of all, they've got high levels of gearing. Now, before that, if I could go into a quick explanation on what a warrant is, basically, if you were bullish and you felt that the markets or the stock was going to go up in the short term, like Zane says, then you would consider buying a call warrant. And if you felt that the market was coming off in the short term, for those examples that Zane was bearish on and felt that we were trading in very close to the resistance zone, you would then buy a put warrant. In both cases, you buy, just depending on whether you were bearish or bullish, you buy different warrants, right? And why would you consider warrants over other instruments? I think, essentially 4 reasons as to why people like warrants. The top reason being for the gearing that you can enjoy via warrants. Sorry, I realized my slide is not moving, is it? Is it moving now? Yes, good. Thanks for that. So the top reason being gearing. Now, this is an example of what UB shares did on the 17th of February after a Facebook Live session I conducted, also during lunch with a trainer known as Beanie, whom I also partnered up with 2 days before at the SGX Trading Festival. And what was being talked about there was how potentially she saw UOB shares coming down very quickly on the back of results that was slated on the 23rd of February. So actually on that day, we did see some investors come in and buy this exact put warrant that we were talking about, RMTW. And if you had done that, over the course of 3 weeks, UOB shares did come down 10%. Post results on the 23rd of February. But if you had bought this put warrant either to hedge against your portfolio of UOB shares or simply to just profit from a downward move that you were expecting, you would have made 85.7%. Now that's a more than 8-time gearing compared to going long via the underlying itself or going short via the UOB futures that's listed on SGX. So that's the top reason warrants offer you quite a lot of gearing that you can probably the most amount of gearing that you can find on the SGX market. At the same time, if you do get your view wrong, it is limited to the small amount of capital that you place up front. In this case, you can see that the put warrant costs only 5.6 cents, which is a very small fraction of UOB shares, which is close to $31. Okay, and that's really the second and third reason as to why they're popular. And finally, trading it is really simple because of the live prices and transparency that we offer to investors who are trading warrants via our website, we've got this tool known as the live matrix, which tells you where the warrants will trade alongside the shares live for each day. So you don't have to guess where the market will be, where the warrant market will be versus where the underlying prices will be. You just come to the live matrix tool and we'll tell you exactly where it's trading, given your view on where the underlying will trade and where the underlying will trade to on the day itself. So how do we use warrants? I guess that's probably the second question that you might have. For the purpose of this presentation, I really just want to simplify it for you to the extent where we will base it off Zane's views, that he just covered. So as a quick example, I think he was bullish. One of the stocks he was potentially bullish on, correct me if I'm wrong, Zane, but it was Alibaba, right? Where he felt that potentially, $92 could be a near-term resistance, but otherwise, it is a close to 10% increase from where we are currently trading as of the morning session, where Baba is currently at $84. If that's the case, you felt aligned with Zane's view and you felt, hey, Alibaba would be a good share to go long into. You can either consider going long via the share itself listed in Hong Kong, or you could consider this trending Alibaba call warrant that we've got, VMPW. And what it will cost you is 5.3 cents from when Alibaba is trading at $84 Hong Kong dollars. Okay, so you trade in Sing dollars for the warrant, right? So you're not exposed. You don't have to convert your capital to Hong Kong dollars. At the same time, if Baba were to go to $92 in the short term, over a 1 week period, you will see that the warrant is offering you gearing in the sense that it will go up to 30.8% 1 week from now. It will go up to 11.5. It will go up by 11.5% if it took 10 weeks, 2.5 months for Alibaba to reach $92. Okay. And finally, if it took Baba 3.5 months to make that 9.5% increase, then you'll find that the warrant is actually unchanged. And the reason for that is because, with listed leverage instruments, whether it's warrants or other instruments, there's what we call a holding cost. For warrants, we call the holding cost time decay, whereby the warrant will decay with time, especially if the market does nothing, the underlying does nothing. But even if it does something, in this case, if it took 3.5 months for the stock to go up by 10%, then the warrant will potentially make no return because of the time decay or the time erosion on the value of the warrant. And what this means is that basically, if you think that Baba is only going to go up by 10% in 3.5 months, then you want to really not consider this warrant at all. Okay, but if you think that Baba could trade up to 10% from now to the next 10 weeks, then potentially you want to consider it. Why? Because the warrant gives you gearing over the shares and it will move up by more than the share percentage, okay, gain. And how do I know all this? I basically use the tool of, sorry, I just realized it's not moving. I basically use the tool of the selector tool here, which I will use to demonstrate to you live in the next example, as well as a mix of the calculator tool and the selector tool. Now, if we were to move on to the next bullish example, bearish example, sorry, of S&P, I'll show you exactly how you can use the warrant selector tool or the warrant calculator tool to know what your returns are. But again, Zane, he was bearish on S&P, where he felt that the S&P would potentially come off by 4.5% in the short term. Currently it's trading at 4,017, and 3,830 would potentially have been a good support level. Now with put warrants, you do the same thing as as how you fix a target level, right? To exit. Basically, you're saying that you want to go short on the futures at 4,000, and then cover it at 3,830. So with the put warrant, it's the same thing. You go short now by buying the put warrant, okay, the S&P put warrant, and then you will exit from the put warrant when the underlying has gone to 3,830, right? Because you think it could be a support level, it might not fall further from there. Now, in that case, we do have a put warrant known as QDCW. It's a trending put warrant over the S&P. And what it's going to do is in a week's time, if the S&P put, if the S&P futures fell by 4.7%, the put will go up by 41.4% to hedge against your portfolio. of shares and other, futures index potentially. If it took 1 month, 4 weeks for the S&P to drop by 4.7%, this put warrant will go up by 8.6%. Again, enough to offset the loss in S&P, right? However, if it took 9 weeks for it to fall, then this will potentially lose money, as you can see on the warrant selector tool here. Now, I just want to quickly use our website and show you how that can be done. Just bear with me. So this is our warrant website, warrants.com.sg, to have a look at how the S&P would do. Just give me a second, sorry. Are you looking at my screen, guys?
It's not showing the website. No.
Just give me a second.
I think there's some.
Can you see my website now?
I still see the slides.
Still the slides or the website?
It's the slides. Ah, I see the website now.
Great, thanks, Alvin. Okay, so warrant website here, guys. How you can use this is, basically, if you're keen on the S&P, what you could do is you could go to our warrant selector tool. Okay, this is a quick way to pick warrants, and like we're saying, Zane is bearish on S&P, so we can pick the S&P, and because you're bearish, you'll buy a put warrant. Okay, and you would scroll down and simply put in your target level here, where he said it was 3830. All right, and simply use this number of weeks, toggle, just keep pressing for a higher number of weeks to see how the warrant will perform. So like I said, if it took 1 week, the warrant would actually go up. This put warrant, this trending put warrant here with the fire logo will go up by 37.5%. But of course, if it took a month, it would go up by 21.9%. And when would it stop making money? You just have to keep scrolling. In this case, if you held it for 7 weeks, it will still make 6.3% to offset the losses in the S&P. However, if you hold it for 8 weeks, 2 months from now, it's actually going to fall by 1.6%. All right, you got in at 5.7 cents and current price 5.7 cents, and it's gonna lose your money, okay, in time to come. And this is a very important tool to help you find out what the warrant holding cost is, to ascertain what kind of holding period, that you would like to have via the warrant. And why is that? Because, with shares, you can usually, some investors think, you can just buy and you can go long on it forever, and let it sit as an unrealized loss, because, it doesn't expire unless the company goes under. But in the case of a warrant, okay, it's got a limited life. It's got what we call expiry. And because it gives you gearing, right, at a fraction of the underlying share price. So what gives? In this case, there is a holding cost, right? And that holding cost will eat into the value of the warrant for, for the longer you hold onto it. So in this case, the longer you hold onto it, you can see that the warrant price will decrease with time, right? So warrants are really just for short-term trading, where you want to maximize your returns, with volatile move in the underlying in the short term. If you felt that the underlying was not going to do anything much in the short term, then obviously, that's a warrant instrument is not something you consider. And likewise, if you think that, Alibaba is only going to move higher in a year's time, make that 10% move in a year's time, then you probably want to consider Tencent, the Alibaba shares directly, buying it instead of buying a warrant. Okay. However, if you think that it could make that move in the short term, then potentially you could consider a warrant. Now, the selector tool will be a good way of estimating your costs, and to know the maximum holding period you should undertake via the warrant. Okay, so I encourage you to use it. There is also another tool known as the calculator, and it does the same thing. In fact, it tells you the exact date that the warrant would actually fall in price as a result of the holding cost. And what you can do here is simply to keep your underlying price unchanged by clicking into the tool on the website, okay, and maneuvering the date to a later date to see when the warrant price will drop by one tick. All right. And how do we select a warrant to trade? Like I said, you can use the selector tool, which is the quickest way to see how you can, how the warrant will perform based on your view. First, you just need to click whether you're bullish or bearish, and then followed by, the target level that you need to have in the underlying, and then the number of weeks. At this point, you're looking at my selector tool, right? I just wanted to check. You seeing my slides?
The slides, yes.
Great. And some of the factors you need to consider when you're selecting a warrant, always have a target entry and exit level. If experts like Zane give it to you, then great, and you subscribe to it, you can then use that to ascertain the exit level in your warrant as well. You need to set your holding period, and in many ways, the selector tool that I've used to demonstrate to you will show you what kind of target holding period, the maximum you can hold onto the warrant for. Okay, and choose the warrant according to what the selector tells you. Gearing, different warrants have got different gearing. Some move by more than 8 times, some move by more than 10 times, some move by 20 times, some move by 3 times, 5 times, etc. And go with what you're comfortable with. The selector tool tells you all the different warrants available. Obviously, the shortcut would be to go with the one with the fire logo. But in this case, you could also consider another warrant if it's got lesser gearing and more comfortable with that. But gearing is also a good way to decide what kind of investment amount you should be investing in the warrant. The gearing level is something that's available on our website easily. You can find out what the gearing level is for each warrant. And how you can use it to also compute your investment amount is simply decide, the amount of investment that you would go long or short via the underlying itself, right? So for example, if you were going to buy DBS shares, you were going to invest 60,000 into it, but you've decided that, hey, actually, I don't want to invest so much, in the share, or I don't want to accumulate more, and I want to use a call warrant to go long in the short term instead. So instead of investing 60,000, what you can do is you can look at this call warrant, or whether you want to hedge on the downside via a put warrant. In this case, you look at the effective gearing level. It says 6 times. If so, then you invest 6 times less. So you use your $60,000 in initial investment in the shares divided by the gearing of 6 times to get an approximate investment amount of $10,000. All right. And whichever warrant you're looking at, you just need to look at the offer price. In this case, if it was 9.8%, you just use the warrant investment amount of 10,000 divided by 9.8 cents, and you will get an approximate amount in the number of units of warrants to buy. In this case, it's 103,000. And this same exercise, you can apply it to any warrant in the warrant market. On our warrant search page, what we're going to find is there is a sensitivity column, that's the effective gearing column, and you can simply look at it to decide on what your investment amount in the warrant should be. Based on Zane's views on the underlyings that he's covered today, this is the list of the trending warrants. If you want a quick, a direction or viewpoint of what kind of warrants you could consider based on his view, here's the list of the warrants that you can consider: over BABA, over Tencent, over the S&P, over Hang Seng, over DBS, and over SIA. Every product comes with risks. In this case, the warrant risk is that, the gearing could work both ways. It could magnify your gains by 40%, but it could also come off by 40% if your view was wrong. They all have a limited life, like I said. So if you wanted to hold on to your view forever, then you need to consider the shares directly as your form of investment rather than via a warrant. Okay, and obviously then if you got your view wrong and you held it all the way to expiry and warrant expired worthless, you could lose your entire investment amount. But the good news is that the investment amount is smaller than the share investment amount, as I pointed out. And to help you find out more about warrants, I suggest you can scan the QR code on the screen now. Whether it's to join our Telegram channel, or Facebook, or YouTube, we regularly partner up with market experts like Zane, and the most recent one we partner up with is Joey, also from Phillip, to provide you short-term views on where you can use warrants to extract the maximum returns and values on. And with that, I'll come to the end of my session. Back to you, Zane.
Thanks, Jamie, for all the insights about warrants. I'm sure we learned a lot. Now I think we can pass on the time to Alvin to talk more about DLCs. Yeah.
Okay. Thank you, Zane. Thank you, Jamie. Hi, everyone. Okay, let me just put up the website. Okay, I hope you can see the website.
Yeah,
so
we
good,
do.
right? Okay, thank you. Hello, everyone. Good afternoon. Just a quick introduction about myself. My name is Alvin Li from UBS, and I am based in Hong Kong. Today, we would like to share with you, especially for those of you who have not heard of this product before. Today, we are going to focus on the basics of this product called Daily Leverage Certificate. And it's also called DLC, obviously. So DLC has been listed has been around, on the SGX for about 5 years by now. So it was started in 2017, and then now it's already it's already 6 years. And but then actually I think quite a lot of investors have heard of it before, but then I'm sure many of them still haven't actually tried it. So I think it'll be great if I can share some of the basics about this product with you. And so DLC is also a type of leverage trading product, and it's similar to warrants in a sense that it's linked to an underlying asset, and it's also like a separate counter. So for example, just now Zane mentioned that he's bullish on Alibaba, for example. You can have a call warrant on Alibaba. You can also have like a bullish type of DLC on Alibaba as well, and that's called a long DLC. So you have a short DLC and long DLC, but it doesn't mean that you are going to like a short sell the DLC in order to express a bearish view. But then the DLCs would come in 2 types. So it's either long DLC or short DLC, as you can tell from the name. And so we would recommend investors to, if you have a bullish view, you can buy the long DLC. If you have a bearish view, you can buy the short DLC. And then obviously the long DLC would go up when the underlying goes up, and the long DLC will go up by more with a leverage. And then the short DLC, on the other hand, when the underlying assets goes down, the short DLC will go up with a leverage as well. So let me. So I think my session will be about maybe 15 to 20 minutes. I'll hope to be able to share with you some of the very basics and some of the I think the like a product specific characters and also bricks that I think we should be aware of before we trade a product. Okay, so I'll be using the website, and first of all, let me just quickly share with you a DLC example. Okay, first of all, if you go to our website, the website link is dlc.ubs.com. It's very easy to remember. And then if you go to products, you will see the first tool is search. And then you see that we have already issued 130 DLCs on the SGX already. And just now I mentioned that DLC has been around for quite a while. It's since 2017, but in fact, UBS is a new issuer on DLC. We only started February last year. So it's about slightly just more than 1 year. but we have already issued 130 DLCs for investors to choose, and we are now covering most of the underlines that we cover are Hong Kong stocks, and we also cover Hong Kong index and also US index as well. So just now, Zane mentioned S&P. Well, we don't cover S&P, but we cover the other two US indices, namely Dow Jones Industrial Average and NASDAQ 100 index. Okay, so as you can see from this drop-down list, you will see that we have covered all these Hong Kong underlines. And then, for example, today, I think Alibaba was this is definitely some stocks that I would highlight because just before the lunch close, we saw that Alibaba actually shot up, spiked up by around 5%, just like within 5 minutes. And then, but just before the morning close, it already retreated a little bit. So now it's only up by around 2%, but still, because today overall the Hong Kong market is down. But then if you look at many of the other tech stocks, for example, Meituan after result is down by around 4%, and Tencent is down by around 3% today. It's down quite much. But then if you look at Alibaba, it shot up, right before lunch close. So this is definitely one of the highlights, especially on the Hong Kong side. Many Hong Kong investors are looking at the Alibaba today, I would say. So I think DLCs, first of all, it can basically offer you a very simple tool to access the Hong Kong market without having to open a Hong Kong account, without having to convert your currency to Hong Kong dollar to trade a product. So all these DLCs that you can see on screen are traded in Sing dollars. They're listed on the SGX, and they're linked to the Hong Kong underlines. Okay. All right. So let me just pick Alibaba's. So we can go to Alibaba here. Okay, and then. So you can see that we have got three, okay, 1, 2, 3. We have got 3 long DLCs here. This one is a long, this is a long, this is a long as well. So we have got 2 short DLCs here. All right. So we have got 5 DLCs on Alibaba already. And let me just pick one as okay, this one I will tell you later why this is not a good pick. Let me just pick this first to as an example to walk you through how a DLC works. Okay, so this product, PHHW, is Alibaba 5 times long UB, so it's issued by UBS, and the expiry of this product will be in 2025 September. Okay, so this product is not going to expire anytime soon, so you don't have to worry too much about expiry. And then so if you look at the right-hand side, you can see that Alibaba now is up by slightly less than 2%. It's $86.9, and it's up around 2%. And then this DLC, which is trading in Sing dollar, is now trading at around 67.5 cents, and it's up by 9.4% compared to the previous intrinsic close. So it's a very if you divide like 9.4 by 1.8, you can see it's close to 5 times relationship, as you can tell from the name. Okay, it's a 5x long. All right. So basically, the leverage of DLC, the reason why it's called daily leverage in the first place is because the leverage is fixed on a daily basis. So you can see that the leverage is even printed on the name. So this long DLC is 5 times long. You can also have 5 times short. For single stocks, currently all the single stock DLCs are 5 times leverage. We are exploring other leverage factors options with the SGX, but then at the moment, all the stocks DLCs are 5 times. But then if you look at index long DLC, short DLC, you can find different leverage factors. You can find 7 times as well. You can, for some of the indices, you can find 3 times. Okay, so basically how it works is simply whenever, like basically for every 1% movement in the underlying assets, you can expect for 5 times, you can expect a 5% movement in the DLC price compared to the previous close. Okay, so it's always we always compare to the previous close. So this is how DLC works. So we that's why we call DLC like a close to close product. But obviously, it doesn't mean that you can only buy right at close. You can day trade a DLC. You can hold a DLC for however long you want. It really depends on you, on your view. But obviously, you have to understand how the product works, all right, before you invest in it. And so for this product, it's 5 times long. And I think it's more transparent in a sense. It's also simpler in a sense that it's always 5 times. So like regardless of the terms, there's no like a strike price or anything. So this DLC in theory will always be 5 times. All right. But then okay, theory is a thing, but then like in practice, how it actually works would depend on the absolute price of the DLC. Because sometimes when a DLC is trading at a very low price, for example, like a 1 cent or maybe even less than that, for those DLCs, first of all, because of the minimum tick limit, I think it's called minimum bid size, right? The DLC, if it is at say 1 cent, it can only take 0.001, which is around 10% of 1 cent, right? So for those DLCs, you cannot expect it to be very sensitive to the underlying movement, because 1 tick is already 10% in the DLC price. And that means in order for this DLC to move by just 1 tick, which is 10%, you will need 2% movement in the underlying assets, all right? And BABA today is up by less than 2%, but it's already considered not too bad, right? Because after all, it's just a stock, right? So when it is up by around 2%, is quite a few already in a day, which means for DLC, if the price is too low, all right, if it's below certain price level, don't expect it to be too sensitive. And in fact, in those scenarios, you should be avoiding those DLCs that are at a very low price. You should be going for the DLCs that are at a higher price. All right. So this may be opposite to some investors thinking, because sometimes we see investors buying quite a lot of the DLCs that are at a low price, hoping that because they think that they'll be able to buy more shares with the same amount of money. But they'll be able to buy more shares, but it doesn't mean that they'll be better off. In fact, they are actually worse off in this case, because the DLC itself will be not too sensitive to the underlying movement. All right, and because after all, the money that you put in the DLC, in theory, will move with the underlying with a 5 times relationship, regardless of the price of the DLC. And when the price of the DLC is higher, the sensitivity will also be better. So that's why you should go for DLC at a higher price, and that is also at a higher, like a better sensitivity. Okay, so okay, maybe I've gone a bit too far. Let me go back to some of the basics of DLCs. So as you can see from here, so this DLC is linked to Alibaba, and the code is PHHW. So it's a separate counter compared to the stock, obviously. And but then I think you will be able to look up this DLC just by the name, okay? And then it was listed around November last year, and then the last trading day will be in, as well as the expiry date will be in 2025. And all right, so just now I mentioned sensitivity, right? So you can see that there's a value sensitivity here, and basically it means that this DLC would require this much change in the stock. So this DLC will require around 14 cents movement in BABA, the stock, in order to move this DLC by 1 tick. Okay, so obviously the smaller this value, the better. All right, because you require less amount in the Alibaba to move the DLC. So you want the DLC to be able to, have to take up and down more in a day, because assuming the market maker is quoting the tightest spread possible, then 1 tick up, you'll break even already, and then the next tick up, you'll be making a profit. So in theory, you hope the DLC to take up and down enough, and obviously you hope it to take up and down, as many as possible in a day. Okay, and on the right hand side, you can see that so just now, right before lunch close, the stock as well as the DLC spike up, as I mentioned. Okay, so in short, this is how DLC works. I think it's a very simple trading product, because of the 5 times leverage. It's very simple. Every day, whenever you look at it, it's supposed to be moving 5 times compared to the underlying assets. Okay, and then I think I can share with you a bit more about 2 things. One is the airbag mechanism. The other is compounding effect. I think these 2 are I would say it's quite specific characteristics about the product to DLC. So this is something that I would like to especially focus on. So first of all, airbag, right? Airbag trigger level, as you can see here. So every DLC has an airbag level. So this one, 15%, means that if today the stock is down by 15%, airbag mechanism will be triggered on this DLC. Okay, obviously it's not very common for a stock to move by 15% in a day, but it's not it's not impossible. In fact, it has happened a few times before for some of the DLC, for some of the underlying stocks. And if Alibaba went down by 15% in 1 day, so it's not like a couple of days in a row, in 1 day, then the airbag mechanism will be triggered on this DLC, and then the DLC will be suspended for around actually it should be around 1 hour in practice. Okay, in the documents it's a half hour, but in practice it will be suspended for around 1 hour before it resumes trading. And if the stock resumes, okay, if the stock didn't end up going down by more than 20%, because if the stock went down by 20%, this DLC will be gone, because it's a 5 times DLC. And if you got the direction wrong, and then the stock went down by 20%, obviously the 5 times long will be wiped out. Okay, so this is the risk of all the leverage products, to be honest. Okay, because it's a leverage product after all. Okay, but then if the stock didn't go down this much and then resumes trading, the DLC's exposure will be reduced, meaning that after the resumption, if the stock goes further down, the loss on the DLC will become less. So that's why it's called airbag in the first place. So the DLC after the resumption will basically have a smaller exposure to the underlying, so it kind of absorbs the impact. Okay, so for further impact on the stock, the DLC will move less. But then in this case, if the stock ends up going back up, it's 2-sided. So if the stock goes after the resumption, if the stock goes up, the recovery in the DLC value would also be less. So it's neutral, it's 2-sided. All right. So this is how airbag works. I think we should be aware of this mechanism that is in place in every DLC. But after all, I think we don't have to be too concerned about this mechanism, because if we got the direction correctly, for example, today BABA is up, the stock, let's say, we got a huge, very big positive news on BABA. Let's say BABA today is up by 15%. On this long DLC, the airbag mechanism will not be triggered. The DLC will be up by, in theory, 15% times 5, which is 75% without suspension. Okay, if the stock is end up going up by 20%, you see the DLC being up by 100%. Okay, so this is this is why I would say we understand the mechanism, yes, but then we don't have to be too worried about it. Okay, so this is about airbag mechanism, and the last thing I would like to quickly mention is the compounding mechanism on the DLC, because DLC, after all, the leverage is fixed on a daily basis, right? Every day it is 5 times, but then it doesn't mean it's 5 times when, like, whatever investment period you look at. So you buy today, you sell maybe next week. In this like a 5-day business day period, the leverage may not be exactly 5 times. The leverage could be slightly more, could be slightly less. It all depends on how the stock move, how the stock behaves over this 5-day period. Okay. Let me put up one example to show you. So Baba today has been doing quite well, but in fact, if you look at all these like a blue chip tech stocks, Tencent, Baba, Meituan, to be honest, they have not been doing very well if you look at, say, February till now. So I think the one that did the worst is actually Meituan, which is something that I would like to share with you. So today, if you look at Meituan, this one, for example, today Meituan is down by quite a lot, another 4%. And this DLC is a short DLC, is up by around 22%, close to 5 times relationship compared to the stock movement. And if we look at this historical compounding return, okay, actually there are quite a lot of useful tools which I strongly encourage you to take a look. After this session, you can go to the website dlc.ubs.com. You can find all these different tools for you to understand how the product works. All right. So if we go to historical compounding return, as the name implies, basically it can show you how the DLC moves historically compared to the stock, in order for you to compare the compounding effect. So here, this is the underlying chart. So Meituan basically has been all the way down since, okay, if we look at this period, this is basically like start of February to around mid-March, all right? In this case, you can see that the stock went down by from 176 to basically all the way to 126, down by $50. All right, and then so it's down in a trend. Obviously, there are days that it recover a little bit, but then just went down further after that. Okay, so if we look at the DLC performance in the same period of time, I'm just putting up an extreme example for you to understand how compounding works. Okay, this remember, this doesn't happen all the time. For Meituan, during this period, Meituan was down by 30%, okay? Like 32 business days together, which is about 1.5 months, okay? From start of February to mid-March, all right? So if you held this product from the very beginning, in beginning of February all the way to mid-March, your DLC would have gone up by 336%. Okay, again, this is a very extreme example, but what I want to highlight is that this is so much more than 5 times leverage. In this case, the stock is down by 30%, times 5 is 150% only, right? But then the DLC end up going up by so much more than 150%, and that's all because of this compounding effect. Okay, so compounding effect would be more when you hold the product for longer, and then it will also be more when the underlying movement is more. Okay, so compounding effect is good when the stock goes in a trend. In this case, the stock goes down in a trend, your short DLC would go up with a compounding gain. And if you bought a long DLC instead, obviously you will be making a loss here when the stock went down like this, but then you will also be losing less. When the stock is down by 30%, you can't lose 150% in the long DLC. In fact, in this case, I would say likely you'll be losing maybe around 80 something to 90 something percent, but then you still have a little bit of residual value in the DLC because the stock is not going down by 30% in one day. The stock is going down by 30% like gradually, okay? And then, so like if you do a bit of calculation, there's no way for the DLC to be completely gone. In this case, you still have a little bit of residual value in the DLC, meaning that in this case, you actually also got a compounding gain in the DLC by losing less. Okay, so these two cases, when the stock is going in a trend, is good for DLC. So DLC is, after all, is a trend trading product. And when the stock doesn't go in a trend, when the stock is sideways, you will be having a compounding loss. In this case, when the stock ends up maybe just unchanged compared to start of the period, your DLC could be at a loss, or the stock ends up being up a little bit, your DLC will be having less than 5 times return, or your DLC, long DLC, could still be at a loss. So this is when you get a compounding loss. So when we trade DLC, especially for the first time, don't hold it for too long unless you really understand how this compounding works, okay? And after all, I think, as I mentioned, I just want to highlight that DLC is a trend trading product. So if you bought the DLC, you realize your view is wrong or maybe too early, and then the stock goes down. If you're bullish, the stock goes down. Unless you think the DLC will come back very, very soon, okay? If not, then don't hold on to the DLC, because chances are when the stock comes back, your DLC could be at a loss if you hold on to a DLC for too long, because over the course of the stock coming back, the stock could be go up and down, and then there can be a lot of compounding loss in between. Okay, so DLC is a trend trading product. All right, so I think I've come to the end of my sharing session as well. Let me pass it back to Zane. Thank you.
Thanks, Alvin, for all the insights when you touch on all the intricacies and all the small details that we need to take note when we are trading with DLCs, which is a different instrument from warrants. Yeah. So I think we can proceed on to the Q&A session. Yeah. So there are a few questions in the chat box. The first one, any comments now on the short-term market view, banking issue and interest rate outlook? Yeah. So would anyone like to take the question?
Zane, I think that question is probably for you, right? On the short-term market view, because you are probably the expert here.
All right, I can share my view on it. Yeah. Sure. Let me just share my screen right now. Okay. Okay, can you all see my screen? Okay, so wow, how I approach is probably a step-by-step process. First, I think I'll touch on how the current banking turmoil has affected the Fed discount window usage, and then touch on interest rates. Then following, I'll make a conclusion of how I think the market will move in the short term. Okay, so with the current banking turmoil, you can see this from the chart over here. The bank usage of the Fed's discount window has actually ballooned to actually greater than 2008 crisis level. So currently it's more than about $150 billion US. And actually, what does this mean? So what the implications is that you can see in this comparison over here, where we take the discount window usage compared with the tightening lending standards, we can observe that whenever these institutions tap on this the Fed's backstop, particularly during these large spikes, we can see that thereafter, what follows thereafter is that there's an increasing percentage of banks actually tighten their lending standards. So this will actually be the same as what Chairman Powell mentioned on FOMC last week, where he saw that there will be a credit tightening. So what this actually means that I would think that small businesses will actually experience more stress going forward, they might not be able to get access to the loans as easily as they could get in the past with increasing lending standards imposed by the banks. So this will actually temper the economic demand also. When we look at the interest rates and look at the side of interest rates, this is the Fed summary of economic projections. So this is the dot plot they actually produced last week. So they actually see that interest rates will be at 5.1% at the end of this year and before dropping to 5.3% next year. But however, when we look at how the market is actually pricing it, is that currently we're at 475 to 500 basis points. The market is actually thinking that in the next few Fed meetings, we'll actually take a pause at this level before actually having some rate cuts along the way. So we can see there's actually growing dissonance between what the market actually prices in and what the Fed actually wants. And of course, from the viewpoint of Chairman Powell, definitely he thinks that in his words, he thinks that rate cuts are not in his base case for this year. He's still maintaining a rather hawkish stance in terms of interest rates relating due to the strong economic data we are seeing. So, but the market is actually thinking that with the current stress in the economic system right now, Fed might actually be forced to cut rates earlier than what is currently presenting to the public. So with that, I do think, in my view, that the market could get it correct due to the current turmoil in the economic system, where we see that the step up in interest rates actually caused quite a lot of damage, particularly to the banking sector. And we see that from the Fed discount window usage, it's actually surpassed the 2008 level. So that's actually quite significant. So we can know that a lot of financial institutions are actually drawing upon this backstop. So to short their balance sheets as well. So that actually represents a sort of stress in the system. Yeah. And then lastly, I would like to talk about this 10-year yield minus 2-year yield chart. So this actually represents the spread between the 10 minus 2. So currently we are below the zero line, which represents an inversion. So however, we see that from a chart wise, we had a bullish breakout above this descending wedge going on. And then there's a potential consolidation taking place as of now. So there's still a lot of the bullish context in this is still present, where we see that there's actually potential chance for the yield curve invert back to the positive normal yield curve. So actually, what are some of the implications when zoom out to the monthly chart, right? Let's say I compare this to how the broad-based gauge, let's say S&P performs when we go back above the zero line. So we can observe back in, let's say, the history 2000, we see when this inverted back above zero, we saw a decline in the S&P over here. And I think this decline was about, from the day of inversion, was over 30 to 40%, close to that. And then back in 2007, 2008, we also saw something similar over here take place. Over here, the S&P actually dropped about close to 50% over here. So what we can associate is that based on history, when we see that this yield spread actually inverts back above zero, then we might have to take some caution as that there could be some significant potential market declines to come to follow in the S&P if we see this phenomenon play out. Yeah. So with that, my short-term view of the market is that I will remain a bit more towards a bearish side given current developments that's happening right now. Yeah. So that's my view on it. So feel free to share any of your views if you have any other opinions.
There's nothing from me. You are the expert, Zane.
Okay, thank you. I think we can move on to the other questions. I think there's quite a few on DLC, so may I invite Alvin to share more?
Yes, okay. Thank you for the question. So I see that the first one from 10V is that okay, can we summarize DLC? Okay, yeah. Thank you for the question. So in short, I think DLC is a very simple leverage product. because of the fact that the leverage is always fixed every day. So it's a fixed 5 times leverage, or fixed 7 times or 3 times, depending on the product design. And basically, you don't have to compare too many terms, between products. All you have to be worried about is, as I mentioned, the sensitivity level, whether the DLC is sensitive enough to the underlying stocks movement. And so basically, whenever you have a short-term view on any underlying, you can check whether there's a related DLC, and especially for those DLCs that are linked to the Hong Kong stocks, you don't have to open a Hong Kong account. You don't have to convert the currency. You can simply check out all these DLCs that are linked to the Hong Kong stocks. All these DLCs listed on the SGX, so you just go to the same Poems account to buy those DLCs, and it also allows you to express both bullish and bearish view, and greater leverage. So you also will be able to save up some capital, because you'll be buying, so the way to look at leverage is that you either get more exposure by putting in the same amount, or the other way to look at it is that you can get the same exposure by putting in less capital. Okay, so I think this is how I think DLC is positioned, and how it can help you to get a potential return. And I think, to be honest, it's actually the case for other leverage products as well. Allowing you to be able to either get the same exposure by putting less, or the other way around. So yeah, so that's pretty much it.
Okay, thank you, Alvin. There's another question on DLC. So from Caleb, it says that how is UBS differentiated from SocGen for DLC, as SocGen has been the DLC market longer?
Yes, thank you for this question as well. Yes, we are the second issuer in the market, and I think, to be honest, if you look at just the product design, it's the same, I have to say, because we are issuing the product under the same DLC program. So by product design is the same. Let's say the rules are the same, so we can we can choose to issue a DLC at different price, different expiry, in order to try to differentiate ourselves. But after all, I think what makes the most difference is the market making. So the fact that we are market making our DLCs compared to other market makers, I think this is when you have to look at, for example, first of all, the counterparty risks of UBS versus other issuers, and second of all would be whether the issuer is able to provide a tighter bid and offer spread, and also a more stable like a market making. For example, like the market making wouldn't suddenly go off, and then, or the fact that the pricing whether is stable enough, whether it's actually moving in line with the underlying stock movement. So on this front, I think because of the fact that UBS is actually on Hong Kong side, we are the largest warrants and CBBCs issuer. If you look at the market share, we're number 1 in Hong Kong. So this actually allows us to be able to provide a better market making, because we have a better, like a more solid foundation, especially on the Hong Kong stocks. To be honest, there will be synergy for us to market make both Singapore DLCs and Hong Kong warrants and CBBCs linked to the Hong Kong stocks. So on this front, we should be able to provide a better market making, especially on the Hong Kong underlying DLCs.
Thanks. Yeah. Thanks for your answer to that question. I think there's another question from Christine. If you'd like to find out more about how the sensitivity number is being calculated, is there a formula for that? Okay, I hope I'll be able to explain it without having us put up a slide. So basically, for DLCs, first of all, you need to look at
how much the minimum bid change is. For DLCs that are below certain price, for example, for DLCs that are below 20 cents, then the minimum tick change will be 0.001. Okay, so basically this value divided by the price of the DLC will be the percentage change on the DLC based on the minimum bid change, right? And then so this percentage, you are now looking at how much movement in the stock would trigger this movement, basically. So this movement is in the DLC. So this movement divided by 5 would be the percentage movement required in the stock to move the DLC by 1 tick, right? And then so you get this percentage value, and then you multiply this percentage value by the stock price. Then you'll get the value. I hope I explained it because I don't have a slide here with me. But then don't worry, because on the website the sensitivity value on the website is not real time. To be honest, I don't think there's a very big value added if it is real time. It is updated every day based on the previous underlying close. So it's calculated by the system. So don't worry, it's correct. And then if there's any question after this session, feel free to call our hotline or email us anytime. And then I'll be able to explain more on that. Yeah, thank you.
Thanks, Alvin, for your explanation on that. I think there's another question on DLC again by Paul. He asked that for DLC, we also need to look at the liquidity of a particular DLC, example, the volume traded, because UBS is the market maker, but you need buyers and sellers for a particular one.
Yes, thank you, Zane. Okay, after I think Jamie will be able to add to that as well, because I think this is not specific to DLCs. Basically, this is question for all the products that have a market maker mechanism, right? So for DLC, yes, you're right. I know quite a lot of investors, they would also look at the on-screen trading turnover on the DLC, because like a common thinking would be that if the DLC is traded more, then it's supposed to be more popular, right? That's true, yes. But whether a larger on-screen trading volume necessarily mean the DLC is safer in a sense, like always have people to trade against you, to trade with you, right? I think this is not necessarily the case, because market maker have an obligation to continuously provide bid and offer. So even if there's no one else trading with you, even if you are the only investors trading with us, we still have the obligation. We always have the obligation, in fact, to always put a bid and offer to move with the underlying price. So in this case, especially for new DLCs, right? New DLCs, you can't have other people to trade with you because it is just listed. So, but then don't worry too much about it, because we have to be there. And if we are not in the market, this is time when you can call us and ask us to give a quote in the market. Okay, so because of this mechanism, I think it's very good mechanism that actually allows all the DLCs to become popular. So yeah, so basically don't worry too much about it, and good on-screen volume is good, but it's not necessary for you to consider whether you should invest in that particular DLC. I think when you consider between different DLCs, what you have to pay more attention to is, for example, as I mentioned, the sensitivity, and also like the issuer, for example, instead of just the on-screen volume. Yeah.
I think there's a need to differentiate between liquidity and volume traded, right? Just because you got, if you have zero volume traded, it doesn't mean that there's no liquidity. So the role of a market maker in general, whether DLC or warrants, is really to provide the liquidity, such that if no one was trading it at all, you still have, like in the case of warrants, 5 million on the bid and 5 million on offer for you to sell to or buy from. So yeah, I mean, some people like to participate only because they see other people trading, but actually, if it was an opportunity that only you spotted and no one else did, then there's still the market maker to provide the liquidity for you, and you wouldn't have to worry about the inability to get in and out just because no one else has spotted the opportunity and wants to trade.
Thanks, Alvin and Jimmy, for your insights for this question. Okay, so we have another question by Liu. For DLC, what time will the market maker actually start and end for each trading day? He adds that does the buy and sell queue disappear in the afternoon around 3?
Okay, thank you, Leo, for the question. I think that really depends on the underlying assets. If it is Hong Kong stock, then we start at 9:30, which is same as the Hong Kong exchange starting time, and then we end at 4. Okay, so which is where Hong Kong exchange ends, and that's basically it. And so you probably will not see market maker before 9:30 and also after 4.
Okay, thank you. I think there's one last question in the chat box for now. By 10V. What's the difference, pros and cons between both DLCs and warrants compared to the other products such as futures, CFDs, and options? Maybe you can hear from both of you.
Okay, maybe I'll start first. I think I would just highlight some of the characteristics that are specific to DLCs. I think first of all, the fact that the leverage is fixed on a daily basis, and which is not like other leverage products. And then also the fact that DLC has a compounding return. Actually, this is also because of the fact that the daily leverage is fixed, and then you have a compounding effect if you hold a product for longer. So make sure you understand it before you trade. And also the airbag mechanism is also specific to DLC, something that we should understand. But then it doesn't happen that frequently, so don't worry too much about it. And I think that's basically it. I think DLC is a just very simple product, and with a fixed leverage for you to easily get leverage to the underlying assets.
Okay, and for me, I think the pros and cons, well, pros, hopefully my presentation has really highlighted to you, high gearing, different levels of gearing depending on your risk profile. And I think compared to all the other leverage products available in the market, it probably demands the least amount of capital, investment capital from you, just because most warrants are traded around 5 cents. Well, the pro of it, I think, whether it's a warrant or DLC, is that they're both non-margin products, right? They're listed on the stock exchange. So they're regulated, first of all, because they're listed compared to unlisted products, OTC products like CFDs and options, which means you basically have the regulator watching you, making sure we're fulfilling obligations, and pricing our product well. And more transparency, obviously, because we're listed, but also because we're non-margin, you don't have to worry about getting a margin call in the middle of the night, right? Where the S&P futures have dived, 8-10%, you need to top up, whether it's with future CFD or option product, you probably have to do that. The cons of the product is obviously, there's got holding costs. It's the same regardless of which leverage product you're actually choosing, right? There will always be a con. CFD, DLC, warrants, options. Warrants, the cons of it is quite similar to options, whereby you have to pay what they call theta, or in this case, we call it time decay, which erodes into the value of your warrant with time. But therein lies the beauty of the product, which is that it is a short-term instrument, right? So if you expect volatility, which I think is characteristic of 2023 so far, where the market doesn't just go nicely in a certain direction, it's a bullish market, sometimes it's bullish for a short period of time and suddenly it becomes bearish again, then I think a warrant product is something that you could potentially look at, taking into account the cons of it, but hopefully the pros of it will outweigh the cons for you to consider to trade this volatile market.
Thank you for both of your answers to this question. I think we still have about 5 minutes remaining, so Perhaps I would just ask some questions about warrants. Okay. So I think one question some investors might be concerned about is that with a movement actually taking place in the underlying, is it possible that some other factors other than time decay, as you mentioned in your presentation, that cause the warrant not to move accordingly?
Yeah, so Zane, time decay is one of the factors that the warrant will not move accordingly. But ultimately, the warrant also moves according to delta, which is something I've not mentioned here. But essentially, the higher the delta of the warrant, the more responsive it will be to the underlying. However, some have got very low deltas because, the underlying has moved against the warrant holder so much and against their view, and probably has very little time left to expiry. Which in other words means a generally low probability of the warrant expiring with value, and therefore it's got a very low value, low delta. In such cases, these warrants are very far off the money. We term them as far off the money, and they have delta perhaps less than 15%, in which case the warrant will not move very much, even if the underlying does. So that's one of the factors. And then finally, there is what we call implied volatility level, which also affects the pricing of a warrant, same as an option, because warrants are a form of options. Okay, and in the case of March, what we've seen is such a spike in volatility, right? Whether it's in the VIX or the fear index, they call it, which means, all options on the S&P generally experience a take-up in implied volatility, in which case it also translated to warrants, whereby all warrants across the board generally, listed in Singapore, experience changes in implied volatility. In this case, it was raised. So what this means is that, when implied volatility is raised, is that if the underlying price has not changed, both call and put warrants have actually increased in price, even though the underlying has not changed. So in such a case, you will find that the warrant is not moving according to what you're expecting. That can happen too.
Thanks, Jamie, for your answers to that. Another question I think we can have is that are warrant holders subjected to corporate actions like right issues or dividends or maybe even tender offers when underlying actually has one?
Actually, that question is probably relevant also to DLCs because it works the same way. Corporate actions like rights issues, special dividends, share splits, they are not priced into, in this case, I will speak for warrants, right? But they're not priced into a warrant. And correct me if I'm not wrong, Alvin, but they are also not priced into the DLC. So, this kind of corporate actions means that when the company announces it, just as the market has been surprised by it, we have to then make adjustments to the warrants to account for it. So in such a case, say special div, right? On the X date, when it goes X for the special div, what's going to happen is the warrants exercise price as well as the conversion ratio, or otherwise known as warrants per share figure, will be lowered so that the impact of the corporate action is not passed on. The impact is passed on to the warrant holders without disadvantaging them. So I think most recently we have seen adjustments, for example, in Capital Corp, where, when the offshore marine arm was merged with Samarine. In this case, both warrants and DLCs, as well as I believe the futures over the single stocks, were adjusted. So warrants are the same, they get adjusted for this kind of special corporate actions, I think we call it.
Yes, that's right, Jamie. So to echo what you said, yeah, that's the case for DLC as well. Basically, for example, one example would be Tencent giving out Meituan shares, I think back in November. And then basically this is something that has not been priced in the product. So basically when it is the ex-dividend day, there will be an adjustment on the, because okay, for DLC's case, because DLC's holders will not get Meituan shares for sure, right? If you're holding like a Tencent DLC. So in this case, Tencent price will go down because of the ex-div of Meituan shares, and basically there will be adjustment to the 10-cent previous closing price on the ex-dividend day to account for it. And then so that that part of a price change in 10 cent will not have an impact on the DLC percentage performance. So that's how we do the corporate action adjustment on DLC space.
Thank you for both of your answers. I think we have come to the end of this Q&A session. So I would like to thank both Alvin and Jamie for taking time off your busy schedules to educate our investors more about warrants and DLCs. Yeah, and a huge thank you to all of our audience who take time off during this lunch to learn more about all these products. So just wish to all of you safe trading and practice good risk management while using all these products as well. Yeah.
Thanks.
Have a
Good luck
great
with
day
markets,
ahead.
guys. Cheers.
Cheers. Bye bye.
Cheers. Bye bye.